What if the next market crash could be triggered by a single invisible trade? One so powerful it's been hiding in plain sight for decades. While everyone watches stocks, crypto, and tariffs, almost no one is monitoring the Japanese yen carry trade. History reveals that the crashes of 1929, 1969, and 2000 shared one common thread: a dangerous, leveraged bet that unraveled instantly. Today, that same risk is building beneath our feet. Picture this. Hedge funds borrow at near zero interest rates in Japan, then leverage up to 100 to 1, chasing higher yields globally. It's a trade that prints money until the yen snaps back or markets panic and the entire structure collapses. Suddenly, the world's biggest banks are exposed, liquidity vanishes, and stocks can plunge 20% or more in a single day. The carry trade is deceptively simple, yet deadly in execution. Borrow $1 million in Japan at 0.5% interest, invest in US Treasuries yielding 4%, and pocket the $35,000 difference. But hedge funds use massive leverage, sometimes 30, 50, even 100 times their capital. When the yen strengthens, losses are magnified and can wipe out entire funds overnight. When these trades implode, banks that lent the money are left catastrophically exposed. The 2008 financial crisis wasn't just bad mortgages. It was leverage, interconnected bets, and sudden monetary tightening that brought the system to its knees. Today's carry trade could be the spark that ignites a new crisis, especially with global valuations more than double their historical averages. JP Morgan CEO Jamie Dimon is sounding the alarm. You are going to witness a fracture in the bond market. It is going to happen. The United States has accumulated over $5 trillion in new debt in just 1 year, with another $5 trillion potentially on the horizon. A fiscal cliff that's, 5 times larger than the 2009 stimulus. As deficits balloon and enthusiasm for U.S. bonds starts to wane, cracks are definitely forming. Bond auctions aren't selling out as quickly, and investors are starting to question just how much more America can borrow before the whole system buckles. Imagine for a second a neighbor asking for bigger loans every single year, while their income only grows 3%, but their debt payments rise 7 to 8%. Eventually, you just stop lending, right? That's exactly the risk America faces now. If buyers start to balk, bond prices could plunge, yields might spike, and liquidity could just evaporate. The result? A sudden credit freeze, surging borrowing costs, and a market panic that could rival any in history. Experts are suggesting it's time to move away from long-duration bonds and towards short-term treasuries. Hedge funds are shifting to market-neutral and macro strategies, hoping to profit from all this volatility. As traditional diversification starts to fail, alternatives like hedge funds and cash are looking more attractive than ever. Warren Buffett really exemplifies this kind of caution. He's sitting on a record $334 billion in cash, actually outperforming the market while others falter. Sometimes, the best move is just waiting for the storm to pass. The most chilling risk out there isn't something external, it's actually internal. Dimon calls it the enemy within: political gridlock, runaway spending, and just a plain old refusal to face hard truths. Congress is, just about ready to remove those spending caps. And that opens the door to even more reckless debt. Without real reform, the United States risks losing its safe haven status. And if confidence falters, the dollar weakens, and honestly, borrowing costs could just skyrocket. Valuations right now are, get this, about 100 to 110% above historical averages. Buffett says this is the most reliable investing metric out there. Higher valuations mean lower future returns. Over a century's worth of data shows that when markets are this overvalued, the next decade's returns are, often flat or even negative. Yet investors just keep ignoring this warning, telling themselves, this time is different. But if you can earn 4% on cash, why take the risk with stocks for a projected 3% return? The risk premium has just vanished. The yen carry trade isn't just some sideshow, it's actually the hidden catalyst that could trigger a global meltdown. When this trade starts to unwind, banks tighten lending, valuations just collapse, and those little cracks in the bond market, they become chasms. It's honestly the same pattern that toppled long-term capital management back in the 1990s. Brilliant minds, massive leverage, and just one miscalculation that nearly buried Wall Street. Right now, we're in a room filled with gasoline. The spark could really be anything: a failed bond auction, a sudden yen movement, a political crisis, or some global shock. And when it comes, the explosion will be swift and brutal. Stocks could drop 20% in just a few days, banks might scramble for liquidity, and honestly, government intervention could come too late. For true investors, every crisis, well, it presents an opportunity. The key is to focus on fundamentals, buy great companies at reasonable prices, and just ignore all the noise out there. You'll survive, and even thrive when the dust settles. Buffett's approach is pretty simple. Buy when others are fearful, hold cash for bargains, and always maintain that long-term perspective. Economic growth is slowing. Those 2025 to 2026 forecasts show just 2% or less. Inflation, it's still pretty stubborn. Consumer confidence is shaky, and fiscal cliff risks are on the rise. But honestly, the greatest danger is ignoring history's lessons. The carry trade, bond market fractures, internal enemies, and sky-high valuations are all warning signs. The next decade just won't look like the last. Good times don't last forever, but neither do bad times. Stay disciplined, keep buying quality, and be prepared for volatility.